In today's video, we're talking about the 5 biggest retirement challenges. So whether you're fixing to retire or whether you've already retired, you need to have an answer to each of these challenges. And that's what we're going to talk about today. Hey, this is Tommy Neesmith. I'm a financial planner at Christy Capital Management. We're trying to bring good, solid retirement information for federal employees so that you can retire better. If you want to talk to an advisor, click right up here. In today's video, we're trying to figure out how to overcome the 5 biggest challenges in retirement. The first challenge is longevity. According to the Society of Actuaries, a man in his mid-50s has about a 1 in 3 chance of reaching age 90, and a woman of the same age has about a 50% chance of reaching it. I found a Social Security website where you can put in your age and it will give you the expected lifespan remaining. Here are my results. At age 42, it says I have an additional 39 and a half years of life expected to live, a total of 81.6 years. But you can see here that if I would have been 62 years old right now, then they're estimating I'll live to almost 85 years old. If you're 67 years old right now, they think you'll live all the way to age 86. So dealing with the problem of longevity is something that you need to have a plan for. Now, the average American out there that does not have a pension has a larger problem with this. But if you're watching our channel, then you're probably a federal employee, which means you will have a robust federal pension. Assuming you're a FERS retiree and not a CSRS retiree, you're also going to have Social Security. And if you're married, you're going to have a spousal Social Security. So you're already ahead of the game compared to most people out there by having at least 2, if you're married, 3 guaranteed income sources. This does a lot of the heavy lifting in dealing with this problem, but it still might not cover all your expenses. So one way to deal with this problem is to get a guaranteed monthly payment annuity with some of your TSP money. Now you can do this through TSP or you can do this outside in an IRA. Some of the benefits of doing this is that it gives you a guaranteed payment for as long as you live. Some of the drawbacks of doing this is you lose access to the balance. And most of the time, the guaranteed payment you have does not increase with inflation. So 20 years from now, you're still getting the same amount. You're giving up some of your control and flexibility with the balance of money because you're exchanging it for a guaranteed payment. Now, for non-federal retirees, lots of people are having to do this to create a pension for themselves. But we find that most of the federal employees we work with, they don't need a guaranteed payment for the rest of your life. That guaranteed payment annuity solves a problem that most federal retirees don't have. You solve that problem with your pension and 1 or 2 Social Securities. We are generally coming from the viewpoint of what TSP balance do you have? How much of that balance do you need to withdraw annually to meet your living expenses? There are certain percentages that you can pull out and typically have the money last forever. There are higher percentages that generally will not last. So you want to make sure that you're doing your research to ensure that you're not taking out too much money too quickly in retirement. This is one of the benefits of working with a financial planner that understands your system and understands what problems federal employees typically have and the best solutions for those problems. Now, the next challenge is volatility. The stock market can have wild swings that seem to come out of nowhere. In 2020, the COVID-19 pandemic caused the stock market to go in turmoil. In 2008, it was the housing crisis. In 1999, it was the dot-com correction. In 2022, it was inflation. Depending on how aggressively you have your TSP invested will depend on how much volatility you're subject to. But last year again in 2022, even the F fund, which is generally considered to be conservative, took on heavy losses. If you look here for 22 returns, it makes sense that C fund was down 18% and the S fund was down 26%. And I fund, it was down almost 14%. We understand that the stock market did not do very well, so it makes sense why those funds would be down. But if you look at the F fund was down 12.83% for the year 2022. The last time that fund was negative was back in 2013. Previous to that, the last time it was negative was 1999. So generally, people are thinking that the F fund, and more specifically bonds in general, would not be subject to too much volatility. But 2020 and 2022 proves that wrong. So one way some people offset volatility is by choosing more and more conservative investments. Yes, that will remove some stock market risk from your portfolio, but it will also cause your returns to potentially be lower over time. If you remember, the first obstacle is longevity. You need to make sure your money is going to last you for the long haul. If you have your money overly conservative and not getting returns that help offset inflation, it may put you at risk of running into some other problems. So that leads us right into the third challenge, which is inflation. Now, for years and years, inflation hasn't really been anything that we worried about, but 2022, that all changed. Now, in the news, that means your Social Security check went up a lot with inflation. And your pension check, well, it got a really large cost of living adjustment as well. But the problem with that is the cost of goods are going up. For people that are living on a fixed income, that can't support those rising costs. You could have a problem. But the good news is that your FERS pensions has a cost of living built in, and Social Security has cost of living built in. In a perfect world, your portfolio would be growing at such a rate that it's growing above the rate of inflation, which will allow you to take longer and larger distributions every year in retirement to help offset this. You can also increase the monthly withdrawal from your assets. That's what you would like to have happen. If your assets are growing at a pace that is outpacing inflation, then you can take withdrawals that are higher each year. Another thing many people are worried about are increased healthcare costs. But as a federal retiree with the FEHB that you can carry into retirement, your healthcare remains just like it was while working. The government pays 72% of your premium, while you're paying 28%. All the co-pays stay the same. The only thing that changes is that the monthly payment that you're making was tax deductible when you were working. But now since you're retired, it's not tax deductible. But everything else, it's pretty much the same. Many of you will opt to get Medicare Part B. Now yes, that's an additional premium, but when you pair FEHB and Medicare Part B, in most situations, you're going to have great coverage and won't be surprised with super high out-of-pocket costs. This is another big advantage of being a federal retiree. Hey, if you're receiving value from this video, please give us a thumbs up. That helps the YouTube algorithm get our videos in front of more people. Now, for the fourth challenge, we're going to talk about taxation. For most people, they think that when they retire, they're going to drop tax brackets. I want to postpone all taxation I can until I retire because surely in retirement, my income is going to be less. Therefore, I will be taxed less. The problem with this thinking is there are a lot of deductions that you have while working that somehow magically disappear when you retire. Your TSP contributions to traditional side that you've been deducting your whole career, well, they go away. The mortgage interest on your house payment seems to go away when you pay your mortgage balance down, so low or even pay it off. All the deductions for having your children seem to magically go away once they get too old, which usually happens around retirement age. Some of the charitable contributions either go away because the standard deduction has gotten higher, or because it goes away in retirement because people typically donate their time as opposed to their money. Whatever the reason, the deduction seems to go away. So yes, your pension will be less than your full salary. But while working, you never received your full salary anyway. When you add up a reasonable sized pension, you add that to your Social Security, you add that to your spouse's Social Security, and then some type of monthly distribution from your assets that are taxable, and then you don't get to subtract a bunch of deductions. In most instances, people are still showing up in the same tax bracket. For example, lots of people that are in the upper portion of the 22% tax bracket while working and then retire, they drop to the lower end of the 22% bracket. So their income went down? Yes. Did they drop tax brackets most often? No. Now this is especially true for federal retirees with your robust pensions. If you are reading a generic retirement information out there, it may say you're going to drop tax brackets because the average person doesn't have a pension. But that pension with Social Security, with TSP distributions, usually puts you in a similar tax bracket to where you are now. Another thing about taxation that is extra worrisome is what do you think the tax rate will be when you retire? What do you think the tax rate will be when you start to take distributions from your assets? What if you don't need distributions? Then what do you think tax rates will be when you hit 73 or 75, when you have to start taking required minimum distributions? If tax rates get worse, then postponing taxes is worse. So this is definitely a challenge that you need to have some type of solution for. We do a lot of work with clients in helping get TSP money moved out into an IRA and then do tax planning using Roth conversions. This is where you take a portion of your traditional money and you move it to a Roth. You pay taxes each year on the portion that you move. You can play the tax bracket game where you see how much money you have left in the tax bracket and move an appropriate amount each year, paying a tax rate that you're comfortable with today to try to shift the majority of the money before future tax increases come. This type of planning is great, but this type of planning is also not allowed inside the TSP. So if taxes are a worry for you, the TSP's fairly limited in how you fix it. If this is important to you and you want help, please go to ChristyCapital.com and click to talk to an advisor. Now, the last challenge is leaving a legacy to loved ones. If it's important to you that you leave money to your family, there is some planning that can be done for this. The federal estate tax limits have gotten so high that many people aren't worried about that. Right now in 2023, you can leave someone almost $13 million as an individual or almost $26 million as a married couple before federal estate taxes kick in. For most of us, that is not going to be a problem. Where the problem lies is if you leave family traditional money, either in your traditional TSP or traditional IRA. That money will be taxable to your heirs. With the first Secure Act that was passed, your heirs now have a limited amount of time that they can take distributions. Whenever you limit the amount of time someone takes a distribution, you are potentially raising the taxes on that amount because you're having to take larger distributions each year because of the shorter window of time, which can move you up in the tax brackets faster. There are some planning steps you can take if you are wanting to leave more money to individuals by using life insurance. Life insurance is a very tax-friendly way to leave people more money tax-free. If you want to leave a legacy by leaving money to a church or to a charity, there are planning steps to do that as well. It's tax-free to leave life insurance to individuals. It's also tax-free to leave traditional money to churches and charities. So there's all types of planning steps that can be taken to leave a legacy in the way that you want. Each person's situation is different, so the recommendations will be different. But the key thing here is you have a plan and it's laid out for your specific situation. All 5 of these challenges are things that we help clients with every day. If you're worried that you don't have a plan to offset each one of these challenges, then reach out to ChristyCapital.com. Click to talk to an advisor, and we'd love to talk with you. If you want to watch a video about how taxes affect your retirement and what to do about it, click right here. Taxes play a huge part in your retirement, so getting that right is important, and this video is all about it. If you want to talk with us, go to ChristyCapital.com, click Talk to an Advisor, and we will talk to you soon.